What's up, Warrior Source Nation? Welcome to a special show right out of the gate in 2024. And by popular demand, I might add, we're going to do a show that we've never done. The three of us actually went out and looked, and we don't see any real piece of content speaking to this really pertinent and relevant question, which is what happens to rates during election years? So it's actually a lot of the viewers have asked us to do this show. Mike Morrison, who you'll see here shortly, and who's been on the show several times, Brian LaFlame, who's co-hosted the show several times, said, "Hey Hills, we should do this show." And I was like, "Great, finally, let's actually do this." And so Mike and Brian went in and actually dug into every single year since 1972, I think is where we'll start, and looked at interest rates before, during, and after. And we're going to answer the question as to what happens to interest rates during election years. Now, Mike, I think there's like a current belief or narrative out there right now. Let's kind of frame up the conversation, and then we'll throw to LaFlame to kind of really dig in. Okay. What do you think that current narrative is right now, Mike?
Oh, it's definitely that interest rates are better during election years or go down. I've been doing this for a long time, and that's always something I've heard year after year. When elections are close, a lot of consumers are saying, "Hey, I'm going to wait. I'm going to see what happens in the election. I know rates are going to go down this year." And I've heard it so often, and I hadn't noticed anything myself, but it just made me wonder, like, is that a true narrative? Is that something that we should know? Is that, as a professional, should I be able to advise my clients like, hey, like rates probably will be better this year simply because of an election? So it just got me wondering, and I wanted to research it. So we went out, as you mentioned, we went back to 1971, and that's just quite simply because rates are very easy to track back to that year, right? That's the Freddie Mac rates. That's where our data is coming from. And so we compiled that. We went and looked at elections every year. They started in 1972 per that rate chart. And we ran through what happened in each election. Democrat, Republican, was it an incumbent winning, an incumbent losing? Which party took over? Which party was in control before? And I put all that data together, and then I needed somebody smarter than me to help me with it. So I reached out to Brian LaFlame,
We called
and we
Barry
just kind
first.
of
Needed an answer, so then we called LaFlame.
yeah. So we just studied it together, and I just wanted to see if it was a true narrative and something that we should be aware of and that the public should be aware of. So I'm excited to share the results of that today.
And guys, before we throw to LaFlame and dig in, let's do this collectively as a group. Like, this isn't political. If you're in the chat log, we're definitely not talking Republican or Democrat. We're simply talking about rates, and we're simply talking about what happened during them. And if you'd made an assumption and it's either correct or not correct, our goal isn't to try to like make you feel bad for that. It's just to merely dig in and go, "Hey, this is what has happened historically." Doesn't mean in what it'll happen in the future, but this is what has happened historically, and really trying to find the truth to that question: what happens to interest rates? And here we are again in election year. And I think you're right, Mike. I think people, and I've heard it this year already. Uh, Realtors and loan officers saying they're either going to go down or they're going to hold. So let's dig in and find out if that's accurate.
Yeah.
Yeah, it's
And
not a red thing, it's not a blue thing, it is absolutely a green thing. Like, we care about helping more families and supporting our
Mhm.
families and pushing the economy forward. Party affiliation doesn't matter here.
And then the further question was not only what do rates do in the election year, but what happens after the election, right? What
Mhm.
what do they do in the year following? So we added that to our research, and we have some cool results for everybody.
All right, so as Mike said, we looked into, and Mike dug incredibly deep on this, we looked into what happened the year before the election, the year of an election, and the year after an election. We looked at when one party switches to another party. We looked at when the party stays the same. So we went Republican to Republican, Republican to Democrat, Democrat to Democrat, and Democrat to Republican. And we're going to look through and just see what happened. One of my favorite attributes in a person is if they're able to be convinced when new information is presented to them. If they have an open mind to just believe what is true. And that's what we went into this with. We had heard this narrative over and over, and I got to tell you, when we started talking about it, right away I got upset because I'm like, no, this doesn't. This is not true. Rates are not affected by elections. And then I started to think, wait, but are they? Because everybody says this every year, so maybe I'm the one who's wrong. And as we dug into it, we'll see what we see. So let's start here. We got Republican to Republican. We went back to 1972, and you could see Nixon went to Nixon from 72 to 72. Obviously, the second Nixon administration didn't last his entire administration, but for the election, we went Nixon to Nixon. The year before, interest rates was 7.43. year of, they're 7.44, and then they went up just barely to 7.84 the year after. And if we're in 2024 right now, we've lived through 2022 and 2023, and just having this small of a rise in interest rates over a year, when we've seen this in like
Mhm.
4 days, would be incredible for us. So we've also got Carter to Reagan, another Republican to Republican, and you can see here they actually went down the year after the election after going up the year before the election into the election year. Reagan to Bush shows pretty steady rates. They went up going into the election, came down after the election. And then Bush to Bush, the same thing. They went up into the election just barely, and then they went up after the election, maybe the most aggressively of all of these Republicans, but still pretty moderately.
So summarizing that chart, it looks like we've got very minimal changes in rates with
Mhm.
Republican to Republican elections.
Yeah, in fact, let's zoom in on 72.
Yeah, I think that'd be a good idea because you really can see before, during, and after. And you guys would be surprised. And I know I'm a big fan of like, hey, 1972 is cool and all, we can learn a lot, but it doesn't necessarily mean that that's going to impact 2024, but it does serve a purpose. So if you look at 72 and you zoom in there, guys, like it's really flat. Like LaFlame, like when does it actually change? I mean, how many months or years later did we actually see an increase?
Yeah, rates don't start to go up until the beginning of first quarter of 1973, and then they start to move up into a recession. And then you can see as interest rates do, they start to go down into the recession. And we actually come out of the recession with right around the same rates that we went into it. But the effect was the economy, not the president, is what I get from this. The
Yeah,
effect was the
totally agree.
economy was moving into something significant that was outside of this presidential election.
Yeah. And then what was the next one, election after that that we can zoom into just to kind of follow along with your chart?
So we zoom into 76 and you can see the same thing happening.
Mhm.
We go 75 the year before, we're super flat. 76, very flat. In fact, rates don't start to go up until the big inflation crisis of the late 70s and early 80s.
Again, and economic driven, not a president driving that,
Not
right?
president driven. Yeah.
Yeah.
And the presidency during that time went from Ford, who took over for Nixon. You guys remember after he resigned. So it went from Republican to Democrat, Ford to Carter. And you could see the average rate before 8.81. When Jimmy Carter was elected, it came down to 8.79, which is for all intents and purposes flat. It didn't move. And then it went up to 9.05, which is not a big difference. So we can see here, we've talked about Republican to Republican. We've looked at a couple of elections and saw that during the election time, rates didn't really move at all after the election, or you could say before the next election, but at a time when there was some economic events that moved interest rates that weren't mortgage presidential election driven. You could see when we go from Democrat to Democrat, interest rates stay relatively flat. In fact, this is probably the largest decrease. One of the largest is Clinton to Clinton in the mid 90s. But you remember, this is when quantitative easing really became a thing,
Right. Right.
much smaller than what we have today. But it's when the Fed first started to introduce quantitative easing was in the mid 90s. And then looking at Republican to Democrat, you have Bush to Obama, where rates went down pretty significantly, almost a full point. But you guys remember what year we transitioned from Bush to Obama, right?
Yeah.
The same year that we've been talking about over and over and over
The Great
again.
Recession.
Yeah.
Yes. So I think, I mean, let's zoom in here. I think I'm going to go on a limb and say we can all agree that 2008, we had some stuff going on
Yeah.
that may have affected the markets.
Yeah, I mean, that was more about obviously, climbing out of the Great Recession, which required lower interest rates, cheaper money than a president changing, hands. And so, I mean, that's the one big outlier. And we'll summarize a lot of the data here towards the end, guys. But that's the one big outlier you'll see is '08. But it's not hard to understand what LaFlame's saying. Like, of course, that was more Great Recession driven than a president. So, what's before we move on, I'm curious, like your guys' point of view, where do you think, there's a narrative that starts somewhere. And like, what do you think the root of it is? Is it just like, hey, the president's got enough power to influence, and it's possible, sure, that's possible, to influence the Fed to go, hey, we really need a strong economy, so I look better to get reelected. And do you think that's where this like was originated from?
I believe that is the case. Yeah, I believe that people think the party in power is going to do everything they can to make the economy good, make people feel good, and basically buy votes. And
Mhm.
what's funny is I think that goes either way, right? Whether there's a Republican
Absolutely.
in power, the Republican side is going to feel good that they're going to keep things well, and then the Democrats, same thing, right? The other side's going to feel like they're doing everything they can to earn those votes in those years. So I think that's where the narrative is stemmed from, and where it's just kind of grown as sort of an accepted fact out there in the
Yeah.
public consciousness.
I think there's that, and there's two other things that I think are important. I think we all understand, and we learned, especially pre-COVID, like in March of 2020, that the markets hate uncertainty. We saw how incredibly, like historically large the market moves in both the bond and the stock market were during such times of uncertainty. And there's some relative uncertainty when it comes to a presidential election, but we've only had two parties since Abraham Lincoln. So, like, there's not a whole lot of uncertainty, but I think the layman might think, hey, the market would like this or this, but there's some uncertainty about which one is going to be elected. So they're just going to pause and then wait to see. And it doesn't ever end up being the case because there's not a whole lot of uncertainty. And then I think it's really difficult, and you really have to care about what affects mortgage rates and why. It's a boring topic. Like, it's
Yeah.
not a thing that people wake up in the morning and say, oh my gosh, I can't wait to find out what's going on with mortgage rates or the bond market, or some sort of asset-backed securitization, or let's dive into what the Fed really said as opposed to what was said. Like, it's boring. And so people don't, why would you care about it? Everybody has something that they're super interested in. This is a thing that would be really hard to be really interested
Well, I
in.
think it's hopium too. I mean, for realtors and loan officers, right? Like it's always, I get it. I play that hopium game sometimes, even right now. Like our hope is that rates come down. I don't care if it's driven by the presidency or not. Like everybody wants to have lower rates so you can close more loans, sell more houses. So I think that's always a little bit part of the equation. But I look at the question again for this year. Maybe I'm naive, but I don't know what your guys' thoughts are, but I really genuinely believe the Fed is solely focused on fighting inflation. They have done so for so long, uber aggressively. None of us have liked it. I think that is on their mind this year, going into an election year, than who's going to be in power at the end of the election year,
I
right?
think
100%.
I was telling a group of realtors and a group of lenders recently, like, we didn't come this far just to come this far. We didn't work this hard through 2022 and 2023, not to now take advantage of all that hard work that we put in. The Fed is the same way. They didn't work this hard to get inflation down from over 9% to where it is now, around 3.5, between 3 and 4%. They didn't work that hard to get it here just to stop. So
Right.
they're moving, I believe, into more of the dual mandate of, okay, well, now that we think we have inflation under control, now we can focus on jobs and making sure that the economy stays afloat. But we saw this last week. We're recording this on January 12th of 2024, or we saw this week that inflation spiked up a little bit. And so that could be super important in the Fed's mind. To your point, Hills, earlier, that could be super important in their mind about, like, they want to fight inflation, and who knows how they're going to react to this little tick up in inflation. That's way more important, you're right, than what is happening. Jerome Powell doesn't care who the next president is. Jerome Powell has a job and he wants to do it well, so he's remembered well. We
Yeah,
can
we've had a
agree
lot
whether
of
he's doing well or
violent
not, but that's what he's doing.
a lot of violent swings since '08, honestly, in the economy, and that's not what the Fed wants. It's not healthy for the economy to have this wild swing left and right, and they really need to. They want to smooth it out. They want to have some predictability. You said that earlier, and you're right, in the economy, regardless of who's going to win later this year, and that's really their sole focus. And it's good. It's good for everybody to have some certainty, some trust in the economy that's not going to go up and down. And one of the before we get to the summary, LaFlame, Morrison did a ton of work, and I want to show one of the resources. So we're going to give you all of the resources. We are the R resource, of course, to help you. We want you to leverage the show to help answer that question, but we also will give you the resources. One of the resources Mike put together, and these guys are top producers. If you don't remember, they've been on the show. Mike's top producer out of Idaho. LaFlame's top producer out of Washington. So they're doing your guys' job in and day out, and so it matters to them as well. But Mike went in, and every single month, and by hand created this every single month before and after all the elections. And you can see again, LaFlame's point, like they really don't move that much before, during, and after. Back in '73, you got to go all the way to July of the next year to see a move. So you can scroll down to every single election and see before, during, and after. So we'll make that available. We'll make LaFlame's slideshow available. And then we're also going to give you the Fred graph that Brian was referencing to earlier, which is really cool because you can zoom in and out to every single year and kind of play along. So all of this will be available. And then let's kind of get to some of the conclusion slides too, Brian, because I think that's really interesting. It summarizes everything that we dug in on into like one or two slides that really help understand and punch home the facts, that are really, rooted in what we just showed you, like actual data from 1970 on.
So let's look at what happened all years, and then we're going to do Democrat, Republican incumbent. And the first, if you're looking at this chart, if it's shared on the screen right now, maybe cut that part out. As we look at the all years, Democrat wins, Republican wins, and incumbent wins, we're looking at two things: basis points, and a basis point is just a fancy way of saying a part of a percent. 100 basis points is 1%. So 1 basis point is 1% of 1%. Just think of it that way.
So
All years,
0.05 is a very, very small figure.
super small change. This average change percent that you see over here is not rates went up 4.77%. So if say they were 5 and they went to 9.77, this is a percent change from the rate before. This basis points just show how little that really is. So this means rates would have gone up from 5 to 5.05. That little.
Yeah, and that's okay. There you go. For all years, right? That's what you're saying.
Yep.
Change in totality was 5% to 5.05%.
So just know that is the crux of the show, that no presidential elections have not affected mortgage interest rates since 1972. So
there's been no pattern, no rhyme or reason to who's in power, who's not, who's changing, who's becoming into power.
The largest percent change on here, and this is not political again, I just want to show how insignificant this is when a Republican wins, it's 40 rates go up by 44.33%. That sounds like, oh my gosh, that could be a talking point for the left. Hey, if you want rates to go down, you need to elect the Democrat. It's less than 5 to 5.5%. So it is an insignificant change, which is almost certainly due to external factors, not the presidential election. And we can see it a different way right here. So the historical change, the change during each election from 72 to 76 to 80s. And remember in the 80s, we had that really big inflation spike that I'm sure a lot of you have heard about because we're going through a very similar market right now. 08, they went down a bunch. We talked about that. Like a Democrat could take a whole lot of credit for this interest rate change, which looks really big on this graph, but we had talked about a bunch in totality. It's not that big of a deal. But the reality of 08 was a recession. The reality of 08 was a housing crash. The reality of 08 was the TARP program, the Troubled Asset Relief Program. And the result of 08 was a ton of Fed intervention, more than had ever been done before. So the Federal Reserve affected rates before Obama was elected and after Obama was elected. They didn't matter who was going to be elected. That's the crux of it. 5 to 5.05% is how rates change in an election year, or 6 to 6.05, or 4 to 4.05.
That's an interesting, go ahead and talk about that. Cause when I read that, I don't feel like realtors or loan officers were necessarily out there telling lies, right? I think there was a narrative that was built that probably never got challenged until, maybe even today. And, when we actually dug into the facts. So don't take any offense to that, but I think that's what happens. We say a thing because we've heard it maybe from our managers and our managers before that. And that's just kind of become the narrative that this is what's going to happen during election years. I love the fact that we dug into this. I love the fact that the viewers asked us to do this. It was fun doing it with Mike and Brian. Our goal was to just give you data and give you facts so you can go out and better educate, buyers, sellers, people that want to refinance, because they're all impacted and they're all making life decisions for their family. So we should be able, and I love that we're giving you guys the resources to really walk that out for them the next time you really want to unpack it, because as Brian and Mike showed, guys, there's other external factors, but it's not necessarily that the president's going to change hands.
Yeah, you said it. Mike and I face these questions every day, so we know you are too.
Yeah.
And now you have the data to back up what you're telling to people. And the Mark Twain quote of a lie can travel halfway around the world while the truth is putting on its shoes. Like Ryan said, you're not lying, but it's a narrative that makes sense. Like it sounds believable, so we believe it. And you're going to have those conversations with your clients and say, hey, are you not ready to list your house because, or are you not ready to pull the trigger on buying a house because? Well, let's talk about what really happens and then see if it actually makes sense for you to do this. Let's look at what the data says and make the best decision for you.
Yeah, I was just genuinely curious if this was a real thing or not. I've heard it so often, and it's mostly coming from the consumer side of things. I think it's just in the public consciousness, and very interesting. Said, I mean, the data really showed us no pattern, no rhyme or reason as to why the rates are going up or down in relation to the election. It certainly wasn't always up or always down. And I think it's just a great lesson that the market ultimately decides what it wants to do. Even the Fed does not fully control what's happening here. Even this week, rates probably should have gotten worse this week as we're filming this show, and the market has decided that no, the rates are getting better this week. So the market does what it wants to do, and it weighs all these factors in. But the presidential election certainly is not a factor or a large factor in any way.
It'd be fun, guys. Is again, this was backed or created because of demand. We'd love to know like what other narratives or maybe myths do you want us to go in and dig into? Like when I hear on the loan officer side, I was like, never lock on a Friday, which I've heard that at the beginning of my career, and I scratched my head like, why? Just like show me the data. Why you never lock on a Friday? Um, exactly. So, what other myths do you want us to challenge? Maybe we do a whole show of MythBusters for real estate and mortgage. That would be fun. We'll wrap with a couple just for fun. Couple rate predictions as we're, it's January 2024 as we're filming this. Recap. Feds kind of feel like they've captured and fought inflation a little bit. We're in a pause mode. LaFlame, will go to you, Mike, and then I'll share mine. What do you think's going to happen? How many rate cuts for this year, and what will happen to mortgage rates because of those rate cuts?
I'm on board with 6 rate cuts this year. The Fed is saying 3. The market is saying 7. I'm on board with 6 rate cuts. The Fed has shown in the past that when from their last cut to from their last raise to their first cut has a life cycle, and then when they start to cut, they really cut hard. The Fed hasn't done in the past 45 years hasn't done anything halfway. They have raised high and they have cut fast.
It's
So
like
I
a
see
mountaintop.
it is, yeah. So I don't
Yeah.
think they're going to change now, especially because of the enormity of the problems that we were in, during the pandemic, post-pandemic with inflation, and then with jobs coming back, and now maybe losing it.
Didn't you have a slide on that actually? For some reason, I remember you having a slide that had a predictability for the first rate cut. And also, when do you think the first rate cut will occur? And then I'll throw it to Morrison after you answer that.
Even with inflation data today, I call, no, I can't back this. I can't walk this back if it's wrong because I'm saying on the other source. I called last year that the Fed would cut rates for the first time in the first quarter, and the market is positioning a huge number that the Fed is going to cut rates in the first quarter. That's what this slide is where the federal funds rate is going to be up top on which date. And so the market is pricing in all of these cuts. And they don't see that the market is saying they're definitely going to cut by May. There's a 2% chance of rates being where they are this time in May of this year, and a 0% chance past May.
So what month do you think is the first rate cut?
I think March is the first rate cut.
March. And then
hey, RC, can
summary,
you edit this out if I'm wrong, just like in a few months?
and then what happens to mortgage rates? And this is just for fun. None of us know. We don't have a crystal ball.
Yeah. Mortgage rates are going to continue to head down. I think we've seen our top. We saw it. We called it our top when we hit 5%. We never should have hit 5% of the 10-year. We had some bond vigilantism like we had in the 90s. And I think the market was speaking to the Fed and saying, all right, that's enough. Like, we're done. Our government cannot continue to pay its debt at these high interest rates. 4% is going to be the ceiling that we continue to hit upon, and until we move pretty substantially down. And so I think we get into the 3.2 level, and I think rates get into the 5s.
Rates get into the 5s. Love it. Morrison, how about you? First Fed rate cut, and then what happens to mortgage rates?
Yeah. I agree to a degree. The Federal Reserve has shown an incredible ability to overcorrect in both directions
Sure
in
have.
the past. They probably should have stopped raising rates significantly earlier last year. I think we're going to look back at that as a mistake, and they will probably go through a mistake of lowering too fast this time as we go down. I think I would look at it a little bit more conservatively than Brian. I believe the economy has shown really remarkable resilience with employment numbers and other things like that. I think there is some weakness there, but I believe we'll have probably 3 to 4 rate cuts would be my estimate at this point. And I believe we'll probably finish the year with an average rate, hopefully in the high 5s. That would be my expectation. With that being said, though, I do want to caution consumers and agents and everybody that's watching this. We were very optimistic about some rate reductions last year, right? In 2023, those not only did not happen, we went extremely in the other direction, right? It was a horrible summer and fall for interest rates. And so if you're a consumer out there, if you're an agent out there, don't wait for the rates to go down if you feel like you're ready, right? You can take advantage of the market right now. We've already gained a significant amount in rates in the last 2.5 months. If you're ready, you're qualified, you feel like you can afford what's out there, do it. If the rates go down, we'll help you take advantage of that later on.
Right.
But if the rates go up, you're going to be very disappointed if you made the wrong decision.
I think my Hopium says Q1. My brain tells me with some of the data, Q2 is the first time we see a rate cut. And I think in totality 4 to 5 next year. And I'm with you. I think a healthy rate for the industry because of inventory concerns and affordability is probably 5.5 to 6. I think that, we're not going to see a hockey stick growth in terms of volume this year. I still think that we're gonna have to roll up our sleeves and go get it. But if we land around 5.5 to 6, I think that spurs on some refinance activity, cash out activity. It gives some people the chance to maybe do some move up, move down, first time home buyers. So I think 5.5 and 6, and first rate cut Q2. So guys, appreciate the time. You guys did an amazing job. Thank you for digging in so much. This was all Brian and Morrison answering the question about what happens to rates during elections year. I think we did a good job there. I hope our goal is that you guys share this, play it at your team meetings. Next time it comes up, share the data, take the resources we give you today, and go educate your consumers and each other. Brian, Mike, thanks so much. You guys did an amazing job. See you guys next week.